This video is going to look at the accounting for petty cash. There are some small immediate payment needs that arise for companies, such as postage or courier fees or minor repairs or low-cost dollar supplies, for which taking the time to write a check and go through the check approval process just is too cumbersome. So a lot of companies will maintain a small amount of cash, which is a petty cash fund. And these cash, you can kind of think of it as a lockbox. And that lockbox of cash is maintained for paying for these small business expenses in a more timely manner than going through the full approval processes to have a check payment prepared. It's important to note that a petty cash fund is used only for business expenses. It cannot be used because one of the employees forgot money for lunch or something of that nature. Only business expenses can be paid with the petty cash funds. Companies will establish a certain dollar balance, and that certain dollar balance is the amount that the fund is established for. As business expenses are paid with cash from the fund, the cash is coming out of the lockbox, and it is replaced with expense receipts to document what the cash was removed to pay for. At any given time, the total dollar amount of cash in the lockbox or remaining in the petty cash fund, plus any receipts for expenses that are also in there, should equal the company's fund established balance. So let's look at an example. If ABC Company establishes a petty cash fund in the amount of $400. Prior to having the petty cash fund, all of their cash is maintained in the main cash account from the bank. In the general ledger, we need to make an entry to notate and to document that cash of $400 is being taken out of the main cash account and put into a petty cash fund. So we're going to establish a new cash account. It's an asset, just like the main cash account, but we are going to debit it and credit cash because $400 of cash is being taken out of the main cash account and put into this new cash account. Note that in total, cash didn't change for the company. The only thing we did was took $400 out of the main cash account and put it into a different cash account. So let's say during July, the company used the petty cash fund to pay for the following expenses. It's now the end of the month and they're getting ready to replenish the fund. The fund had been used to pay travel expenses, customer business lunches, express mail postage, and office supplies. The total expenses were $260.20. Because the petty cash fund is low, they want to reimburse it to get it back up to its established amount. So the first thing we need to do in a replenishment is figure out how much cash is needed to replenish the fund. So if the amount of cash remaining in the fund at the end of July was $137.80. We counted the cash and figured out that was the amount of cash left. We need to get the cash back up to a required balance of $400. There is currently $137.80 in there. We need another $262.20 to get the petty cash fund back up to its established amount of $400. So now that we know the amount of cash that needs to be taken out of the main cash account to put into the petty cash lockbox, we also need to figure out the amount of the expenses that were paid. So step 2 is to calculate the total amount of expenses that were paid by the fund. When we added up all those receipts, the total amount of expenses were $260.20. But when we counted up the missing cash, we figured out that $262.20 was missing. Expenses of $260.20, missing cash of $262.20. There's a difference there, and that's not all that uncommon. There could be a human error in counting, or the exact change wasn't available, so there's a small difference here of $2. This is called being either short or over. So when we do the replenishment, the first thing we need to put into our entry is the amount of cash that we're pulling out to replenish the fund. We need cash of $262.20. So that's coming out of the main cash account. Because all of those expenses that had been paid by the petty cash had not been recorded in the general ledger, because as the expenses were paid, the receipts were just put into the lockbox. The general ledger didn't know that those expenses were incurred and paid. So we now need to record all those expenses in the appropriate expense accounts. The difference between the expenses and the amount of cash missing is really what we're going to plug the journal entry for. In order to make this journal entry balance, we need more debits of $2, because when I add my debits, they total $260.20, but my credits total $262.20. So I know I need to credit this account $2. So my account that I will use is the cash over and short account. Because we are debiting it for the shortage of $2 in the petty cash fund, this account is going to act like an expense account. If we had the reverse situation, where the amount of cash missing was less than the amount of expenses, we would use the same account. The only difference is we would be crediting that account because the expenses would be exceeding the cash missing. That would result in this account acting like a revenue account. So this account can be debited or credited depending on what we need it to do. It can either act as an expense or as a revenue account, depending on what its balance is.